Hello, everyone. Wall Street has the attention span of a gnat. Let me tell you what happened 2 weeks ago. Here's what we all thought. The 10-year Treasury was going to go over 5% interest, which seems good to us. You get higher interest payments. But for the bond market, that was going to be catastrophic. And then interest rates were going to go from 5% to 15%, and the world was going to end. And then one report came out about the inflation rate being lower than expected, like 0.1%, and everything changed immediately. Suddenly interest rates are dropping. We're going to have Fed rate cuts, and all is going to be right with the world. And the market just swings wildly on every little thing now. Let me give you an example of how off this is. So here are just some headlines from this week. Walmart crashes on disappointing guidance, warns that consumer spending is deteriorating. All right, so what does that mean? Walmart caters to the middle class, the lower middle class, and most of us shop at Walmart. The really rich people don't go there. Walmart's got a pretty good read on what's going on outside in the real economy, and they're warning about it. Then that second headline, industrial production plunges in October as automaker strikes hit. Well, okay, what's this telling us? Yes, they solved the automaker strike problem. Everybody got a huge pay raise, but wait, that would be inflationary, which is what the Fed just said wasn't going to be a problem, but now this belies that. Plus, industrial production is dropping. That's a sign of a slowing economy. And then the last one on that page, continuous jobless claims surge to 2-year high. What's that telling us? Continuous jobless claims? That means people are still looking for work, or people don't want to go to work and just doing that fake thing of pretending to look for work. But the reality is the job market as strong as everybody says? So you would think that Wall Street might look at those headlines and go, this isn't really good news, but instead the market rallied. So we'll get to that in just a minute, because there's one other part. Let's talk about the war 2 weeks ago. The war is going to escalate. Iran's going to get involved. Saudi Arabia, the whole thing's going to spread all across the region. Get ready, hunker down. Well, and then it didn't happen. And we could talk about why it's not happening, or maybe it's just delayed. But let's see if that meme or that line of thinking was correct. This is just from today, or Friday, excuse me. OPEC plus, so those are all the OPEC nations plus Russia, considering additional 1 million barrel oil production cut amid outrage over Gaza war. All right, we talked about this before. You don't always have to wage war militarily. You can wage war economically. And how can OPEC get back at the West? Cut production, raise prices. All right, and is the war really ramping down? Huge smoke plume billows from U.S. base near Erbil as Iranian media touts the strike. Wait, Iran striking U.S. soldiers over in the Middle East. Well, sounds like a little bit of escalation to me. And then we've got the third one. U.S. warship intercepts drone fired from Yemen against Israel. All right, so you've got a U.S. warship intercepting missiles from Yemen. Where did Yemen get the missiles? Probably from Iran. And everyone on Wall Street was thinking, well, Israel has gone into Gaza. They're doing what they need to do, or they're going, regardless of how you want to word it. Israel's in there prosecuting the fight, but nobody else is engaging in this. Therefore, the war is going to be okay, so the markets rallied. All right, does any of this really make much sense? Well, here might be the reason. Futures, treasuries rise amid growing rate cut bets as oil bear market signals recession. All right, let's think about this. All right, wait a minute. We're going to have a recession. Therefore, we're going to have interest rate cuts. Okay, I get that. Therefore, the stock market rallies. What does this mean? What it tells you is the financial economy has totally disconnected from the real economy. Good, we're going into recession. If we go into recession, then the Fed will cut interest rates. And if the Fed cuts interest rates, that's good for everybody in finance. Well, okay. I mean, maybe it's good for people in finance, but it's not good for the real economy. This isn't how things used to be. The stock market used to move based on the real economy. Industrial production was going up. Employment was going up. People's standards of living were rising. Companies like Walmart, Target were seeing bigger sales. It doesn't happen like this anymore. We don't pay any attention to the real economy on Wall Street. It's all about, do you get interest rate cuts so the money will flow, and the money flows to Wall Street first so they win. That's a problem that we have right now that will eventually reconcile. And I promise you, Main Street will beat Wall Street because that's the real world and not the financial world. So let's close on a couple of happier notes, though. The middle headline, Einhorn turns to gold. Investors are too complacent about geopolitical uncertainty. Well, that's what Walt and I believe here at Zanetti Financial. Wall Street is totally underestimating what's happening on Main Street and what's happening in the greater picture overseas, the instability, chaos, war, that kind of thing. But there's one more piece of good news. Walmart and Costco considering ditching self-checkout lines amidst black backlash. Maybe we can close on a happy note. We're doing the best we can to shelter your portfolios for what's going on out there. And I believe we're on the right track here. And if I don't have to do self-checkout anymore at Walmart, that's just icing on the cake. Now on to Walt.